Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. The markets came down 800 points today. FIIs are on a selling spree and valuations are sky high. What is really happening? Well, in this video, we will discuss the array of factors which are contributing to the Sensex throwing a tantrum, various sectors which are set to soar in 2025, and how, as investors, you can turn this volatility into an investing opportunity. So, let's begin. To understand what is really happening and what to expect from this fall, it is very important that we do not forget history, because if we do so, then we are doomed to repeat the same mistakes. Right? So let us first check what historically has happened when the markets have fallen. I have compiled a data for the last 10 years or so, 10 to 15 years, and which gives us a fair enough idea about what to expect after every market fall. Now we start with 2008 2009 crisis, the global financial crisis, the housing bubble in the US. Sensex fell 52% from January to October 2008. The recovery time was approximately 15 months. Next, 2011 European debt crisis. Sensex dropped 25% between November 2010 till December 2011. Recovery time about 12 months. 2013 taper tantrum. Sensex declined 13% between May and August 2013. Recovery time around 4 months. 2015-16, the Chinese stock market turbulence. Sensex fell 26% between April 2015 and February 2016. Recovery time approximately 11 months. Then the mighty COVID pandemic hit us in 2020. Sensex dropped 38% between January to March 2020 in just 2 months. Recovery time about 11 months. This recent correction, which began in September 2024, Sensex has fallen 11.79% till date in the past 4 months. The second reason for this mighty fall is FII selling. Now, foreign institutional investors have been net sellers in January 2025. They have offloaded 69,000 crores worth of equity. Now, contrast the DII, domestic institutional investors, have stepped in with 66,000 crores worth of net buying. Now, FII ownership in the equity markets in India has fallen to 16.2%, a 10-year low, while DII ownership has risen by a similar percentage, which is also at a 10-year high. One of the primary reasons for such mighty FII selling has been the sky high valuations in the Indian stock market. Now, we will just go through the data for large cap, mid cap, and small cap stocks with their current PEs in comparison to their 5 and 10-year averages. So, it gives you a fair idea about how valuations have ballooned in the recent years, right? The current PE ratios as of January 2025 for large cap Nifty 50 stocks stands at 21.87. The 5-year average PE ratios for large cap stocks stands at 22.5. So the current PE is slightly lower than the 5-year average. The 10-year PE average for large cap stocks stands at 20.8. So currently, large cap stocks are trading at a slightly lower PE than its 5-year average. Whereas when you compare the same with the 10-year averages, it is on a higher side. Now, this will throw a googly. Yeah, the mid cap PE, the current mid cap PE, I'm talking about Nifty mid cap 150 index, stands at 38.5 now, which is a 58% premium to Nifty 50. If you compare this with the 5-year average for mid cap, it stands at 33.2. and the 10-year average stands at 30.5. So you can see how inflated the PE ratios for mid cap segments are. We'll go to small cap now. Now, small cap, Nifty small cap 250 index, the PE ratio today stands at 26.55. The 5-year average is 28.7 and the 10-year average is 25.9. So, this gives us a fair enough idea of how inflated the space in the mid cap and small cap segment is. And this is exactly one of the main reasons for heavy selling by FIIs in the stock market. Budget for this financial year is 1 week away. On 1st of February, the finance minister will present a new budget. In the past 15 years, we have compiled a data which shows how the markets have reacted 1 week before the budget, on the budget day, and 1 week after the budget. Now, to give you a rough idea about how the markets have reacted, we will first look at what happened in 2014, 10 years back. 1 week before the budget, the markets were 0.9% in negative. On the budget day, they were 40.48% positive, and 1 week later they were again in negative 1.6%. In 2019, 5 years back, 1 week prior to the budget, the market were in green with 1.4% higher. On the budget day, they were 0.59% up, and 1 week after the budget, they were 0.2% up. What happened last year? Well, we were going to face elections, and no one knew what was going to happen, what results the elections would throw, right? So in 2024, 1 week prior to the budget, the markets were in negative 0.9%. On the budget day, again in negative 0.93%, and 1 week later, they were in positive 1.2%. Now, if you see the historical average for the past 15 years, what has happened over the past 15 years is 1 week before the budget, the market on an average has been in negative 0.52%. On the budget, the market has been in green 0.26%. And 1 week after the budget, on an average, the market has been in plus 1.36%. So, historically, this is what data shows. Let us look at some global economic indicators. Now, as per IMF data, global GDP growth is projected at 3.3% for 2025 and 2026. Now, this 3.3% is below the historical average of 3.7. As far as the US economy is concerned, it is expected to grow at 2.7% in 2025, slightly higher than the previous estimates. Again, Chinese economy is slated to grow at 4.6% in 2025, again a little on a higher side than the earlier estimates. As far as India's GDP is concerned, it is projected to remain solid at 6.5% in 2025 as well as 2026. As far as inflation is concerned, which directly affects demand, it is expected to decline to 4.2% in 2025 and a further decline to 3.5% in 2026. Next, let us check if there is a correlation between the movement of the US markets with the Indian markets. Now, in recent years, this correlation has decreased. Currently, the correlation coefficient stands at zero point 0.4 to zero point 0.5, down from zero point 0.6 to zero point 0.7, which is historically recorded. Now, in the past decade, the Dow Jones has delivered a CAGR of 9.75%, whereas the Sensex has grown at 9.70%, albeit with a higher volatility. How is the interest rate environment? Well, currently RBI has maintained the repo rate at 6.5%, but end of February it is expected to cut rates by 50 basis points. The US 10-year-old bond yields are hovering around 4.5% in early January, and another rate cut seems to be highly unlikely after the new administration has taken over. Geopolitical factors play a major role in market volatility. Now, Trump's policies with potential tariffs on China, Mexico, Canada, India have created market uncertainties. Israel has declared ceasefire in the Middle East, but the Ukraine Russia borders are still burning, which adds to the global uncertainty. What is going to happen to crude prices? Well, crude prices are forecasted to average at around $74 a barrel in 2025, down from $80, which it is currently trading at. Now, this could ease India's import bill, but it still remains a near term risk due to geopolitical uncertainties. How about earnings growth potentials? Well, analysts forecast a short-term slowdown in earnings, but in for financial year 2024 till 2027, Nifty 50 earnings are expected to grow at a CAGR of 15%. Analysts are optimistic about double-digit returns in sectors like infra, chemicals, defense, healthcare, renewable energy, and capital market related companies. Retail participation in the equity markets remain strong, with SIP inflows hitting a record high of 25,320 crores for December 2024. The average number of retail applicants for SME IPO has jumped to 2.3 lakhs in January 2025, up from 29,755 in 2022. So, tenfold rise in the last 3 years. Technical indicators show that Nifty 50 is currently trading below its 50 and 100-day exponential moving average, which signals a bearish momentum in the short term. As far as RSI levels for major indices are concerned, they suggest that market are not yet oversold and remain vulnerable to further corrections. Top performing sectors in 2024 have been Nifty Realty, which was up 48%, Pharma 39% in the green, IT up 36%, Auto 33%, and PSU Banks 26%. Underperformers have been FMCG, which grew at only 7%, mainly because of muted demand and inflationary pressures. So, how should we investors turn this volatility into an opportunity? Well, many analysts are of the view, and I list down those sectors of potential positive returns in these sectors in 2025. Now, infrastructure is likely to benefit from government spending and focus on development. Banking and financial services sector can be potential beneficiaries because of RBI rate cuts. Real estate sector, again, lower interest rates will benefit the real estate sector as it will boost demand for housing. Information technology sector, well, despite initial concerns, this sector has shown resilience and has grown at good rates last year. So it is expected that the growth will flow into 2025 as well. Renewable energy sector is again one such sector which has good potential growth because of green initiatives of the government, which may drive its growth. Defense potential increase in defense spendings and focus on make in India are some of the points which will benefit the defense sector in the country. Pharmaceutical sector again is slated for potential positive returns, but because of domestic market growth and export opportunities. To conclude, what is the best course of action for investors? Well, maintaining a diversified portfolio across asset classes and sectors is one of the crucial things to do. Then, focusing on quality stocks with strong fundamentals and sustainable business models rather than going for momentum and market buzz. One should focus their attention on business ideas which sustain through storms and volatility in the markets. Thirdly, consider increasing allocation to large cap stocks as the valuations are reasonable and they add a stability to your investment portfolio. Then, Use of SIP, we all know that people are well aware about the benefits of SIP. So use of SIP to average out purchase costs over time is also one of the ways to benefit from this volatility. Stay invested for a long term, as historically data has shown that markets recover over a period of time. Thirdly, keep an eye on global trend, particularly Trump's policies and their impact on trade. And lastly, monitor RBI's actions on interest rates and currency management, that they are going to have an impact on inflation and interest rate consumer demands in the country. So, watch out for these factors and the sectors that I have told you, which are recommendations by many analysts across the country. So whatever be the movements in the market, there is always an opportunity to benefit from volatility, provided you are well informed, you take advice from experts in the field, and show patience and resilience. Always think long term and not short term gains. That is the way to earn money and increase your wealth over a period of time. If you have liked this video, which I hope has added value uh, in your investment decision making, please like, subscribe, and share my channel for more such informative content. Until next time, stay safe, happy investing.